You're listening to Ask the Expert on Sprott Money News.
Hello again, everyone, and welcome back to the February edition of Ask the Expert here on Sprott Money News. I'm your host, Craig Hemke, and with me on the line today is Grant Williams. Grant is internationally known as a newsletter writer and speaker at many investment conferences around the world. His newsletter, Things That Make You Go, is one of the most widely read that you'll find anywhere. He's also one of the founders of Real Vision Television, an online and on-demand finance channel that showcases the brightest minds in finance, and I encourage everyone to check that out as well. Grant, thank you very much for spending some time with us here at Sprott Money News.
Craig, it's a great pleasure. Thanks so much for having me.
Hey, if you could, just take a second and in your own words, I guess, describe your own background and what brought you to, I guess, what you're doing for a living today.
Well, I've been in financial markets now for, I hate to admit it, but over 30 years. And during that time, I started off, my first job in the markets was in the Japanese equity markets in the mid-'80s when those markets were going crazy. So I had an up-close and personal view of a huge bubble in real estate and equities in Tokyo. I was a bubble, and the Japanese real estate bubble officially burst. So that was a real baptism of fire for me, and from there I ended up in the US when the Nasdaq bubble burst. I was in Hong Kong for SARS, and I was in Australia for the GFC. So I'm in Singapore now, so it might make sense to keep an eye on Singapore. Something bad's probably going to happen now that I'm living there.
Just waiting for the next shoe to drop then, huh, Grant?
Yeah, it seems that way. This trouble seems to follow me around.
Well, I tell you what, let's just dive right in, my friend. For regular listeners of the Ask the Expert program, we've submitted, or at least asked for questions to be submitted from Sprott Money customers around the world. We let them know who the expert's going to be, and they send us questions. And so I like to then turn around and pass them on to you. The very first one, it has to deal with your long-term macroeconomic view, Grant. And in that sense, do you think that the global central banks are beginning to lose control of the markets?
It's such a great question, and I think it's arguably the single most important question that people have to really have an opinion on right now, because what we've seen since 2009, I guess, when markets bottomed, we've seen what optically looks like a recovery. And it's been touted as such by central bankers and politicians all around the world. And as I said, optically, things have bounced. Nominally, they've bounced. But beneath the surface, the news isn't so good. And that's a lot of what I try and do when I write, is just point out the things that perhaps people should be paying a little closer attention to in order to try and kind of flesh out the whole picture. And since 2009, the overriding narrative has been one of central bank control of markets and the markets dancing to the tune that the central bankers have been playing. And that has come mainly in the form of repeated stimulus. And there's been this concerted effort by central banks for sort of 4 or 5 years where they were all on the same page. They were all trying to levitate markets higher. And that was done through, first of all, the slashing of interest rates. Then when we reach zero, what's been described as the printing of money, it's a little bit more complex than that, but we will at some point, I think, get to the very simple stage of literally printing money. But that's all been predicated upon the markets having faith in the central banks, faith in what they've been telling the markets, and faith in the fact that they will be there with a backstop should things not work out. That's given people the latitude and the confidence to buy assets and take them higher. Now, for the longest time, I've been saying that the one Achilles heel on this is this whole idea of market confidence in central banks. And at some point, I've been worried that confidence is going to disappear, because essentially, if you look beneath the surface, there's been no real recovery. Things are not better than they were. They're certainly not back to where they were before the crisis. And when you've thrown amongst the central banks about $12 trillion, you've ended up with the weakest economic recovery in history. And so if people start to question that the central banks are in control and they are being effective and they are engineering a genuine recovery, all it takes is people to start questioning that narrative, And once they do that as investors, they then have to try and invest accordingly. So if you believe that the central banks aren't in control and you believe that what they're doing is not going to have the outcome they're promising you, then you have to invest accordingly. And that means what we're seeing in recent weeks and months, and that's going to cash just to be on the safe side. And the problem then becomes one of liquidity. And as I've written about and spoken about in the past, in a rising market, liquidity is essentially endless. There is always stock for sale at a price. If the market's rising, it may be 10% higher, but someone will offer you stock at a price. People have forgotten over the last 7 years that in falling markets, sometimes there is no bid. And when you establish that and you are reminded of that fact, it's too late. So I worry that if markets do start to believe that the Federal Reserve, particularly along with the ECB, Bank of England, Bank of Japan, who are probably the closest to being up against the wall, once markets realize this and there's any kind of coordinated move for the exits, you are going to see what we've seen in the first couple of months this year magnified to a degree which the central banks won't be able to cope with because they are out of bullets. So we could see some very extreme measures, which is why we now find ourselves staring down the barrel of a negative interest rate environment and talk about the outlawing of cash.
Well, that's a perfect. Oh, I'm getting some feedback, actual Grant. That's a perfect segue for the second question that was sent in, and it has to deal with negative interest rate policy. You talk about bullets and what might be the next one in the chamber for these central banks to fire at the world. The second question deals with that. As negative interest rates proliferate around the globe, what is the likelihood that this phenomenon will spread to the U.S. and Canada?
Well, look, I mean, Japan, as I said earlier, I was living in Japan when the wheels started to fall off, and that was 25 years ago. And Japan has slowly and steadily moved to a place where it didn't want to go, but everybody all along has assumed that that was just Japan. It's not something to be really worried about because the US isn't Japan and Europe isn't Japan. And I was reading a piece literally today by Stephanie Pomboy of Macro Mavens, who is absolutely brilliant in her analysis. And she pointed out that when the Nikkei bubble burst in 1990, 12% of the Japanese population was 65 or older. And when the same thing happened, the housing bubble burst in the US, 12.4% of the population was over 65. The comparisons between Japan and the US are terrifying. And if you look at where the JGBs are now, 10-year JGBs have a negative yield. The Japanese central bank has been paid $484 billion to borrow money in the last 6 months or so. And people think that can't happen in the US. But unfortunately, the path that all these guys are on is identical. And so people need to be able to comprehend outcomes that they just haven't given any credence to this point. My friend and partner in Real Vision, Raoul Powell, was on CNBC talking about the chances of the US 10-year rate trading at 50 basis points. And the anchor was absolutely gobsmacked. She couldn't believe that he was actually saying it. But you look at Japan, you look at Germany, both of those countries are in that position now. And there really is no reason why the US doesn't end up there. I mean, they're going down the same path. They're pursuing the same policies. And this belief that the US is immune to the kind of problems that Japan faces, the kind of problems Europe faces, because it's the US, is just not a smart way to think. Now, they might avoid it. I'm struggling to find a sensible course of events that will avoid it for the US. But to rule things out, rule out extreme events simply because it's the US, I think is a foolish thing to do. So to me, the US is heading towards negative rates just like everybody else is. Whether they get there or not is to be seen, but you have to factor that into your thinking as a possibility, and a very real possibility.
Third question, Grant, is similar to that last one. We're trying to assess global impacts and how they might affect back in the U.S. and in Canada. One of the big stories so far in 2016 has been just the meltdown of some of the European banks. And a lot of that is due to negative interest rates, but it's also due to what appears to be significant commodity derivative exposure. And so the third question is, there are potential derivative issues at Deutsche Bank and Credit Suisse. Do you think there are any U.S. or Canadian banks that have that same exposure?
That's another good question. I mean, look, banking, I think we all know, is the second oldest profession in the world, and the banks are, the business models are all the same. You know, these guys, they used to make money on interest rate spreads. That's been taken away from them now. They can't borrow and lend with a spread and make a nice safe profit. That's just not there anymore for them. And as we move further into negative interest rate environments, that just gets more painful. If you look at the chart of European banking sector and the Japanese banking sector, you know, two regions that have negative interest rates, you'll see that those banking stocks are down 30+% in the last year or so. You know, that's where the US is heading as they move towards that. The US banking sector is only down, I think, 12 or 13% in that time. But these guys have the same business models, and for every derivative that's outstanding on Deutsche Bank's balance sheet, you better believe there is a similar position on JP Morgan's balance sheet, on Citigroup's balance sheet. And it's not just the US, obviously. You know, UBS, Credit Suisse, and some of the Asian ones. If you look at HSBC, you look at Standard Chartered. Now, you know, I don't have the numbers, but I am certainly not naive enough to think that these banks do not have their own significant derivatives exposures. It just so happens that the Deutsche Bank number is so extreme. You know, it's about the same size as global GDP, notionally. That it's the one making all the headlines. But whether these banks have similarly outsized positions, the defense against it is that it's not gross exposure that matters, but it's net exposure. But as someone pointed out very succinctly and very clearly recently, you only need one failure in the custody chain, and suddenly gross exposure is all that matters.
Right.
And that's the danger. You know, so Deutsche Bank, you can see what's happened to the share price recently. It's under enormous pressure. It's way too big to bail out. It's also impossible to let that thing fail. So that's a decision I suspect that people may have to make at some point in the near future. But once you start looking at those banks and you look at someone like JP Morgan, for example, it's not an awful lot different to Deutsche Bank. The only differences, I guess, are in the regulatory regimes, the policing of these banks. And whilst the US may be slightly better than Europe, it's certainly not a safe jurisdiction. It's not something that I particularly would want to take as a risk on my own book. So I think all the banks are in a similar boat.
Understood. And to that end, then, I guess that's another good segue to the next question, Grant, in that we've talked about negative interest rates. There's this seeming war on cash as we get more and more trial balloons on almost a daily basis of eliminating hard currency, you know, just to really focus folks on keeping their, I guess we'll call it money, in the bank and nowhere else. To that end, if this continues to play out, how concerned are you about the institution of global capital controls?
Oh, look, I think they're here. I think they're here. They're here to stay for the next little while. And unfortunately, they're complex things. And such things, until you reach a tipping point in the number of people that understand what's being done to them, these things tend to stay entrenched for a while. And when you talk about trial balloons, I mean, you can't open a newspaper without talking about the banning of the 500 euro note or the 1,000 Swiss franc note or the $100 bill. And it's very simple to understand why this is being floated. The narrative is that it's exclusively drug dealers and terrorists that use $100 bills or 500 euro notes or 1,000 franc notes. And so it's a great narrative to say, well, this is why we're doing it, because bad people use them. If you look at the US currency in circulation, there's about $1.4 trillion in circulation, and about $1.2 trillion of that is $100 bills. Mm-hmm. So if you ban the $100 bill instantly, you're essentially banning cash. And if you think about the end to this, if you outlaw cash altogether and people just have essentially digital bank accounts, you can take rates negative 10%, negative 15%. There's nothing anybody can do about it. You can't have your money elsewhere. It's a digital entry somewhere. So people who are taking cash out of the bank and putting it in a safe at home, or they're moving into gold as an alternative store of wealth, are doing very sensible things. But ultimately, you are fighting an organization in terms of governments and central banks that do have the power to force you down blind alleys, to do have the power to confiscate wealth. And unfortunately, and this is the key thing to understand, they have a very real need to do that in terms of the outstanding debt that they all find themselves under. So if you give someone a need and the means to sate that need at the expense of other people, generally speaking, they're going to do it. So people have to understand that right now they are in a very confrontational relationship with governments and central banks, and they have to try and stay ahead of this. And as I said before, that involves countenancing the kind of outcomes that people don't like to think about.
Yeah. And to that end, Grant, it definitely augurs for the physical possession of gold and silver for anyone of a number of reasons. But you got to store it someplace. You can hold some of it yourself, but if you've got it inside, you've got to hold it someplace. A lot of folks think about storing it outside of their country, outside of their own personal jurisdiction. The fifth question is, what do you see are the pros and cons of storing precious metal in jurisdictions such as Singapore or the Cayman Islands? And do you feel that any one place is safer than the next or a better alternative than the next?
That's not a great question. I mean, look, we don't know. The problem is it's hard to really think through what could happen here. And once you get into an environment where extreme outcomes start to become the norm, it gets very, very difficult to protect yourself against all the various things that could potentially happen. As far as gold goes, I've been a gold bull for a long, long time now, and it's been, the last 4 years have been a bad time to be a gold bull, depending on why you were owning it. For the people that bought it at 1900 thinking they were going to sell it at 2000, well, gold could be any asset. It's nothing to do with gold. You bought the wrong share at the wrong time. You bought Cisco right before it went down. You bought Lucent Technology. It's nothing to do with gold. But owning gold as an insurance policy, owning gold as a diversification of wealth is a whole different kettle of fish. And I think if you are going to own it, if you do the mental work required to understand the need to own gold, you then the next kind of fork in the road. Okay, how do I own it? Do I own it through the GLD ETF? Do I own it by gold miners? Do I own physical gold? And most people, having done the work and understanding, I really should own some gold, they then realize that to do it the right way is as is often the case, is to do it the hard way, which is to buy physical gold, work out where to hold it, how to buy it, how to store it. And that's a little bit too much work for some people, but to understand you need to own it and then buy a piece of paper that doesn't give you possession of it is just a foolish thing to do. So I think if you're going to own gold, you do need to own it physically. You do need to own it outside the banking system. If your gold is in a bank vault and we end up with a bank holiday, as we've had more times than people care to understand over the years, then you're not going to have access to that gold, and the chances are it will be, or some of it will be confiscated from you. So owning it in a third-party vault outside the banking system. And when you talk about owning it offshore, we've seen in the US back in 1933 with Executive Order 6102, FDR made it illegal to own gold in the US. So there is precedent there to have to turn your gold in. I think it would be a much harder thing to do today, but still, relatively speaking, it's a very small percentage of US citizens who own gold, so it doesn't play too badly to confiscate it. If you try to do that kind of thing in Asia, where almost everybody owns some gold, and it may only be one coin, but families in Asia grow up with gold being passed down through the generations. And for a government in somewhere like China or Singapore or Korea or Vietnam to try and confiscate gold, they would unleash all kinds of trouble that they really don't want a part of. So to me, owning gold somewhere in Asia makes an awful lot of sense. Singapore and Hong Kong are probably the two most sensible places, but storage facilities are springing up all over Asia, and I think for very good reason. So, my position on this is probably rather too well documented given the performance of the price in the last few years. But I think everybody should own some gold, but be very thoughtful about how and where they own it.
Yep, that's tremendous advice. Grant, as the final question, let's just kind of speculate and look over the horizon a little bit. I always tell my readers, that tomorrow is not going to be like yesterday. You've really got to be forward thinking in this environment. And the last question that was sent in had to do with the eventual replacement, or whether there will be something to run parallel to the dollar, which has been the global reserve currency now for 70 some odd years. The specific question was wondering if you see maybe something out of the Shanghai Cooperation Organization, working with something like the Eurasian Economic Union, perhaps, having them cooperate in some way to introduce some type of new gold-backed currency, or whether that's just the direction we're headed. Do you think that is ultimately an alternative that will be presented here in the 21st century?
Well, I mean, what an audience! What a fantastic set of questions. It's funny. Monetary regimes have come and gone throughout history, and we happen to have lived through a period, as you said, of 70 years of a very stable monetary regime, with the dollar being the global reserve currency. And so anytime you get a period of time of that length where the status quo is just very, very solid, people have a hard time in imagining a change to that. And so, if you'd have been around right after World War II, 1950, and we'd have been having a talk about the dollar no longer being the global reserve currency, well, it only had been for about 5 years, so it wouldn't have been a big thing for people to get their heads around. Now, it's almost impossible for most people to get their heads around. But every single fiat currency in history has failed. I'm English. The Brits had the global reserve currency with the pound. The Spaniards have had it. Even Portugal, who now are one of the most indebted countries in the world, had the global reserve currency at one point. Ultimately, the dollar will be supplanted. There's no two ways about it. But when you're at or close to the point where that might happen, it just seems like a bridge too far. But I think what you're talking about here in terms of a gold-backed currency, again, people struggle. Because we've had essentially 45 years with no gold backing, and a lot longer without pure gold backing, people think it won't ever happen again. But gold has been a part of the monetary system for 6,000-7,000 years, and it will be again. Whether it's a hard gold peg, it would be hard to see how that would work. But having a currency that has some form of backing in precious metal, to me personally, having sat and thought about this for more hours than I care to remember, that's not a huge stretch at all, and any drive towards that will necessarily come out of Asia. It'll come out of China, it'll come out of maybe India, and it will be something. It will be a group of countries in that part of the world that get together to do this. My own belief is that the Chinese, when the time is right, will move to a gold-backed yuan. But I think we're a little way off from that unless things really start to fall apart. So again, it's one of those extreme outcomes that you don't have to necessarily act on right now, but you need to have a plan. You need to have a plan for all these things, what you would do if these things happen, because they happen very, very quickly. And if you let them happen while you're trying to figure out what to do, it's going to be too late.
Excellent advice. And Grant, as we begin to wrap up, please tell everybody again where they can find your work on the internet.
Sure. My letter, Things That Make You Go Hum, is I write that twice a month, and you can find out more about that at the website, which is www.ttmygh.com. That's thingsthatmakeyougahum.com. And Real Vision Television, which is a project that I started about 15 months ago with my partner, Raoul Powell, which is an online financial video service which showcases just as many of the really smart financial minds that we can find, and we sit down with them for in-depth conversations that really give them a chance to explain their thinking. And we've been just delighted with the feedback to that. And you can find out more about that at www.realvisiontv.com.
And it's tremendous. And I wish you the best of luck in those ventures, Grant. Thank you so much for spending some time. It's been a real pleasure to visit with you.
Oh, Craig, likewise. It's been a thrill. Thank you so much.
And from all of us here at Sprott Money News, thanks for listening to this month's Ask the Expert.